This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 4, 2026, and this is the Tokyo session. Now, let's get into it. Markets are caught in a paradox. The SIBO Fear and Greed Index is screaming fearful at 14 out of 100, yet major currency pairs are rallying hard against the US dollar. It is Tuesday, August 4, 2026, and the Forex market is showing signs of a structural disconnect between retail sentiment and institutional positioning. Let's look at what the data tells us right now. On the calendar today, we have three key data points that could shift the tone for the US dollar. First, U.S. durable goods orders are released today, offering a snapshot of business investment confidence. Second, JOLTS job openings are due, providing fresh labor market granularity following yesterday's ISM manufacturing PMI release. And third, the U.S. trade balance for June is coming in, which we already know came in wider than expected at minus $73.3 billion, compared to the minus $73.0 billion estimate. Apex, what does this confluence of data suggest for the dollar's trajectory?
It suggests a fragmented picture. On one hand, the wider trade deficit and the flat 10-year two-year yield curve at plus 0.45 percentage points provide a fundamental headwind for the dollar. But on the other hand, we're seeing the dollar index, DXY leveraged funds, sit at a strong net long of plus 4,438 contracts. So, while the macro data is softening, the institutional bet hasn't fully rotated yet. We are seeing a tug-of-war between a weakening macro backdrop and entrenched dollar positioning.
Turning to the market overview, the most striking feature this morning is the divergence in the Eurozone. Euro-dollar has surged above the 1.15 psychological level, currently trading at 1.1508, up a modest 0.1%. Meanwhile, cable is languishing at 1.3426, down 0.1%, and gold is testing critical support at 4,051.72, down 0.6%. The VIX is also compressing, sitting at 15.99. Let's dive into the headlines driving this action. We have several key developments from Forex Live. First, Treasury Secretary Bessent made remarks to CNBC that might be hinting at an imminent Bank of Japan rate hike. Additionally, the Fed's Paulson stated that his vote was not a close call and noted that underlying inflation is too high. How does this policy divergence play out in the cross-currency landscape? This is the core of the decoupling we are seeing. Bessent's hints regarding a Bank of Japan hike are clashing with Paulson's hawkish hold on U.S. rates. The market is pricing in a narrowing yield gap between the U.S. and Japan, which directly explains why dollar-yen is consolidating near 157.6405 instead of chasing highs. More importantly, this divergence is fueling the euro's strength, with the Fed stuck at 3.63% and the Bank of Japan potentially tightening. The carry trade dynamics shift. The leveraged funds have responded by adding 816 net euro contracts this week alone, bringing their net position to 1,269. They aren't just playing the headlines, they are front-running the policy pivot in Tokyo. So, the flow is explicitly moving into euros as the Bank of Japan narrative strengthens. Let's look at the second headline. U.S. Treasury Secretary Bessent. We may have an Iran deal tomorrow to open Hormuz, and euro-dollar surges above 1.15 helped by yen intervention. Focus shifts back to fundamentals. How does the Iran news impact the broader risk appetite we are seeing in the carries?
It's driving the risk-off paradox. The headline about opening the Strait of Hormuz is supposed to reduce geopolitical risk, which typically boosts risk assets. That is exactly why we are seeing aggressive buying in commodity-linked currencies. Look at RC dollar, which is up 0.31% to 0.701875. Leveraged funds have piled into the Australian dollar, with a net long of 27,618 contracts. Similarly, Asmussen is holding at 17.306, with Mexican peso longs totaling 63,807 contracts. The institutional money is treating the Iran news as a green light for carry trades, completely ignoring the 14/100 fear index. Retail is scared of war risks, but the smart money is buying the Aussie and the peso because they believe the supply shock is resolved.
But we need to be careful about calling this smart money entirely justified given the volatility metrics. The VIX is at 15.99, which is essentially flatlining at the bottom of its 5-day range of 15.82 to 20.88. When volatility is this compressed, any surprise, whether it's a delayed Iran deal or a hawkish surprise from the Fed, can cause a violent unwind. We are seeing leveraged longs building up in Aussie and Euro, but the lack of volatility premium means there isn't enough cushion for a sharp reversal. If the VIX expands beyond 20.88, those long positions in risky currencies could face rapid margin calls, forcing a cascade of sell-offs regardless of the fundamental news.
That's a crucial risk flag from SPECTER. Let's dig deeper into the technical structure of these moves, starting with euro-dollar, which is leading the charge. Grid, what does the chart tell us about this breakout above 1.15?
Technically, the close at 1.15078 is significant because it invalidates the immediate bearish bias within the 5-day range of 1.14343 to 1.1559. The pair cleared the 1.15 resistance zone, which had acted as a cap in previous sessions. We are now trading near the upper bound of that range, with the 5-day high standing at 1.1559. The structure suggests that buyers are defending the area above 1.15. However, we haven't seen a sustained extension beyond 1.1559 yet. The path of least resistance right now is higher, but we are running into the edge of the range. If we fail to hold above 1.15 on retests, this becomes a liquidity trap.
And that's why the flow data supports the continuation. As Pulse mentioned, the leveraged funds added 816 contracts. This isn't just algorithmic stop hunting. This is funded by new capital entering the long side. If we see a pullback toward 1.14343, which is the 5-day low, we shouldn't expect a breakdown. We should expect institutional bid support. The flow profile suggests that dips are being bought, reinforcing the technical breakout.
I'd add that the fundamental driver reinforces the technical level. The 10-year, 2-year yield curve is flat at plus 0.45 percentage points, and real GDP growth has slowed to 1.5%. These are recessionary signals. Typically, that would weaken the euro. But the fact that the euro is strengthening despite these weak European growth signals indicates that the market is attributing the dollar's weakness to the Fed's inability to cut, not Europe's strength. It's a relative value play. The technical breakout at 1.15 is simply the price action reflecting that the dollar has nowhere to hide. Interesting. So the euro's strength is really a reflection of Fed fatigue. Now, let's look at cable, which is doing the opposite. It's at 1.3426, down 0.1%, and struggling near the lower end of its 5-day range. What's happening with the British pound?
Cable is exhibiting structural weakness. The price at 1.3426 is sandwiched between the 5-day low of 1.3333 and the 5-day high of 1.35065. We are currently trading near the lower quartile of that range. The candle action has shown negligible gains, and the pair is in a downtrend from the August 2 peak. Unlike the euro, which broke out, the pound is failing to find traction. The technical setup favors downside here. We are approaching a critical support zone near 1.3333. If that level breaks, we could see accelerated selling as the market prices in uncertainty around the upcoming Bank of England rate decision on August 6.
The flow data backs up the technical weakness. While leveraged funds are long the euro and the Australian dollar, there is no comparable surge in pound longs. In fact, the absence of bullish positioning in the pound, combined with the strong dollar longs in the DXY, leaves pound exposed. There is no institutional bid stepping in to defend the 1.34 area. Without that flow support, the technical breakdown towards 1.3333 is highly probable, especially with the BOE decision looming. Traders are de-risking ahead of the Thursday announcement.
And don't forget the safe haven rotation. Even though risk assets are popping, the Swiss franc is being sold aggressively. Dollar Swiss is at 0.810385, down 0%, but the leveraged funds are net short Swiss franc by 9,647 contracts. That's a massive bearish bet on the Swiss franc. Usually, when you see pound weakness and Swiss franc selling, it's because investors are fleeing to the dollar. But here, the dollar is also consolidating. It's a confusing environment. The safe haven bid is gone, but the risk-on bid is concentrated only in Aussie and MXN, leaving pound and Swiss franc in the cold. That isolation makes cable vulnerable to any negative sentiment shock from the BOE.
So, pound is isolated, with no flow support and technical pressure pointing lower. Let's turn to gold. Gold. It's at 4,051.72, down 0.6%. It's testing support, but not breaking it yet. What's the story there?
Gold is holding at 4,051.72, which is a critical juncture. It recently reclaimed the intraday low of 4,042.64 from August 4, but it remains well below the 5-day high of 4,120.15. The structure is bearish overall. We are in a downward channel. The fact that it bounced off 4,042 suggests some defensive buying at that level. But the momentum is clearly downward. Unless we see a decisive reclaim of the 5-day high, the path of least resistance is still down toward the 4,019.14 5-day low. The technical picture is ugly. Every bounce is getting weaker.
The positioning confirms the technical ugliness. Leveraged funds are net short gold by 670 contracts, and that short position has deepened by 130 contracts week over week. The smart money is explicitly betting against gold right now. Combined with the bearish Swiss franc positioning, it looks like institutions are rotating out of precious metals and into industrial/commodity currencies like the Aussie and MXN. They are prioritizing yield and growth sensitivity over pure safe haven status. That's a very specific signal. They don't expect a crash. They expect a stabilization where risk assets outperform bonds and gold.
I agree with CIPHER on the rotation. The core PCE is at 3.29%, which is above the 2% target. Fed's Paulson said underlying inflation is too high. In an environment where inflation is sticky, but growth is slowing to 1.5%, gold doesn't offer the same appeal as it did in a deflationary scare. The market is pricing in higher for longer rates, which hurts non-yielding assets like gold. The 4,050 level is being tested because the floor has shifted down. The bounce off 4,042 is likely just a pause before the next leg down, unless inflation data suddenly surprises to the downside. So gold is caught in a vice, technically weak, fundamentally pressured by sticky inflation, and actively sold by leveraged funds. Let's look at one more currency pair that's showing interesting momentum, Aussie dollar. It's up 0.31% to 0.701875. We've heard about the flows, but what's the technical setup?
Aussie dollar is trading at 0.701875, up 0.31%, within a 5-day range of 0.69463 to 0.7059. The price is currently sitting in the middle to upper part of that range. The daily candle is showing strength, pushing towards the 0.7059 high. Technically, this is a breakout attempt. If it closes above 0.7059, we open up space for further gains. But we need to see volume confirm this move. Currently, it's holding above the mid-range support. The structure is bullish, contrasting sharply with the pound and gold setups we just discussed.
The volume is there. As I mentioned, leveraged funds hold a net long of 27,618 contracts in the Aussie. That is a massive position size compared to the Euro's 1,269. This isn't a small speculative bet. This is a large-scale institutional allocation to the Australian dollar. The reason is clear. The combination of iron ore demand expectations and the carry trade benefit from rising rates in Australia versus stagnant US rates. The flow is overwhelming the technical resistance. Even if grid sees resistance at 0.7059, the buy orders from leveraged funds are likely absorbing that liquidity, turning resistance into support.
Just remember the VIX context. This Aussie rally is happening in a low volatility environment. If the VIX snaps back up, which SPECTER warned about earlier, those Aussie longs could be extremely vulnerable. The 0.7059 level is a thin spot. If the Iran news stalls, or if the Bank of Japan hike delays, the unwinding of those 27,000-plus contracts could be swift. We are riding a wave of optimism that is fragile.
Let's bring it all together for the final synthesis. We have a market where the fear index is at 14, yet Euro, Aussie, and MXN are rallying. Pound and gold are lagging. Apex tie this together.
This is a classic smart money vs. dumb money setup. Grid flagged the euro-dollar breakout at 1.15078 as a technical invalidation of bears, and CIPHER confirmed that this is backed by 816 new contracts, proving it's not just noise. Pulse explained that this is driven by the Bank of Japan/Fed divergence, while SPECTER correctly identified that the low VIX of 15.99 makes this entire risk-on rally fragile. The consensus here is that institutions are rotating out of safe havens like gold and Swiss franc, evidenced by the 670 net short gold and 9,647 net short Swiss franc, and into high beta carries like Aussie and MXN. The cable weakness at 1.3426 is the canary in the coal mine. It's showing that without explicit Fed support, the dollar remains the anchor, and only specific currency-specific drivers, like Bank of Japan for yen or Iran for Aussie, can break that trend.
To summarize our pre-market analysis, the euro-dollar breakout above 1.15 is structurally supported by central bank divergence and institutional flow, but remains vulnerable to VIX expansion. Cable is technically weak and lacking flow support, heading into the BOE decision. Gold is testing 4,050 support amid bearish positioning and sticky inflation narratives. And Aussie dollar is leading the risk-on charge with heavy leveraged buying. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.